This cheat sheet introduces the full mining lifecycle from project inception to closure. Mining is a long, capital-intensive process, and each stage carries different risks, requirements, and investor priorities. The purpose of this guide is to show the big picture, connect the stages together, and help investors understand where value is created or destroyed. As we move through the presentation, we'll look at the main phases, the technical and financial milestones, and the key questions investors should ask at each point in the mine's development. At a high level, the mining life cycle can be grouped into 4 major phases. First comes concept and exploration, where companies search for promising mineralization. Next is definition and studies, when resources are estimated and project economics are tested. Then comes permitting and development, which includes legal approvals, financing, and construction. Finally, the mine enters operations, and, eventually, closure. This framework is useful because it simplifies a complex process into a sequence of value-building stages, each with its own timeline, capital needs, and risk profile. For investors, the mining life cycle is not just a technical sequence, it is also a shifting investment framework. In the earliest stages, the focus is discovery potential and geological risk. As the project advances, attention shifts to resource scale, engineering studies, financing, and permitting. During construction, execution and budget discipline become critical. Once production begins, investors focus on costs, cash flow, and reserve life. And near the end of mine life, closure liabilities and reclamation obligations matter more. Understanding these transitions helps investors evaluate mining companies more accurately at every stage. Stage 1 is concept and target generation. This is where a company moves from a broad regional idea to a specific exploration target. The process starts with regional geological review and data screening, then moves into securing land tenure and building a geological hypothesis. From there, the company defines target areas for fieldwork and drilling. For investors, this stage offers the lowest initial capital intensity, but also the highest geological uncertainty. The central question is whether the company has identified a credible target with enough technical rationale to justify further exploration. Stage 2 is early exploration, where companies begin fieldwork to confirm whether mineralization is actually present. Prospecting, mapping, sampling, and geophysical or geochemical surveys are all used to gather early evidence. These activities help define structures, alteration patterns, and the possible presence of economic metals before major drilling begins. This stage is still high risk, but it is an important filter that separates weak concepts from stronger targets. For investors, the main value lies in early confirmation, while the main risk remains the possibility that promising signs do not develop into a meaningful discovery. Stages 3 and 4 move the project into advanced exploration and resource definition. At this point, the company begins serious drilling and trenching to define the size, grade, and continuity of the ore body. If results are strong enough, infill drilling and geological modeling follow, leading to a formal mineral resource estimate, or MRE. This is a major transition because the story shifts from speculation to quantification. For investors, confidence improves as geological understanding increases, but technical risk is still meaningful until the resource can be demonstrated with sufficient scale and quality. Stage 5 is the economic studies phase, where the project's technical promise is translated into financial viability. The process typically starts with a preliminary economic assessment, then advances to a pre-feasibility study, and finally to a full feasibility study. Each step adds more engineering detail, better cost estimates, and a higher level of confidence. These studies are critical because they determine whether the resource can support a profitable mine. For investors, this stage is about de-risking. A project with a strong study can attract funding and move forward, while a weak study can stop development completely. Stage 6 is permitting and financing, one of the most important transitions in the mining lifecycle. Even a technically sound project cannot move forward without environmental approvals, community support, legal permits, and construction funding. Environmental impact assessments reduce regulatory uncertainty, while social license helps protect the project from delays and opposition. At the same time, financing confirms whether the market believes the project is viable enough to fund. For investors, this stage is often where external risk becomes most visible, because success depends not only on geology and economics, but also on people, policy, and capital markets. Stage 7 is construction and development. This is where the mine is physically built through site preparation, mine access development, plant construction, and tailings or waste management infrastructure. Capital spending is highest here, and execution risk becomes a major factor. Delays, cost overruns, or engineering problems can materially damage value before the mine ever produces its first ounce. For investors, the key question is whether management can deliver the project on time and on budget. This stage is less about discovery and more about disciplined execution, technical competence, and capital control. Stages 8 and 9 cover commissioning and production. Commissioning begins with dry run testing, followed by the introduction of ore and gradual optimization of the plant. The goal is to ramp up safely and efficiently to design capacity. Once the mine reaches steady-state production, the focus shifts to metal sales, cost control, sustaining capital, and reserve replacement. This is the stage where a mine is expected to generate revenue and free cash flow. For investors, the emphasis moves to operating performance, margins, and consistency, because this is where the project must finally prove its economic value. Stages 10 and 11 focus on expansion, optimization, and closure preparation. Once a mine is operating, companies often look for ways to improve value by increasing mill capacity, refining the mine plan, or bringing in smaller satellite deposits. These efforts can extend mine life and improve economics. At the same time, responsible operators begin planning for the end of the mine by updating closure budgets and preparing for eventual shutdown. For investors, this phase is about maximizing remaining value while also recognizing that depletion is inevitable and closure liabilities need to be planned well in advance. Stage 12 is closure, reclamation, and post-closure. Once mining ends, the company must cease production, dismantle infrastructure where appropriate, rehabilitate the land, and ensure long-term environmental stability. Monitoring continues after closure, especially for water quality, tailings facilities, and geotechnical conditions. Companies also remain responsible for legal, environmental, and financial obligations long after active mining has stopped. For investors, this stage matters because closure costs and liabilities can materially affect the final economics of a project. A mine is not truly finished when production stops. It is finished when the site is safely and responsibly closed. This timeline view shows how risk evolves across the mining lifecycle. In the earliest stages, the biggest uncertainty is geological. Is there a real deposit, and is it economic? As the project advances into resource definition and economic studies, technical validation becomes the focus. Permitting and financing introduce external and funding risks before construction begins. In short, risk does not disappear as a project matures, it changes form. For investors, understanding where a company sits on this timeline is essential, because each stage demands a different valuation framework and a different expectation for return and risk. Late-stage mining risks are often underestimated by investors. During construction, the biggest threats are delays, capital cost overruns, and quality issues. During the operating life, the mine faces cost pressure, operational disruptions, and exposure to commodity prices and foreign exchange. As the mine matures, reserve depletion, falling production, and uncertainty around closure costs become more important. After closure, long-term environmental and legal liabilities can remain. The key lesson is that risk continues throughout the life of a mine. Production reduces geological uncertainty, but it introduces a new set of financial and operational challenges. Investor focus changes depending on the type of mining company. In explorers and juniors, the key metrics are discovery potential, resource grade, scale, and drill results. For developers, investors care more about net present value, internal rate of return, capex, permitting, and metallurgy. Once a company becomes a producer, the focus shifts to metal output, all-in sustaining costs, free cash flow, and reserve life. Mature producers are evaluated differently again, with more attention on mine life extension, cost control, brownfield upside, reclamation cost, and liability management. Context matters because the right metrics depend on the stage. The main takeaway is that the mining life cycle is long, complex, and highly capital-intensive. Every stage has its own opportunities, risks, and investor priorities, and those priorities evolve as a project moves from idea to production and eventually to closure. Investors who understand the full cycle are better positioned to ask the right questions, evaluate projects more realistically, and avoid common mistakes. This framework is designed to support more informed mining investment decisions by putting technical, financial, and life cycle risks into a clear structure that can be applied consistently across different companies and projects.